Hi, my name is Manish Bhatt, and I'm the Vice President of State Tax Policy here at the Tax Foundation. Thank you for joining us for State Tax Policy Bootcamp 2026, a series of sessions that is designed to equip you with valuable and timely insights on tax policy issues. Our first session is on property taxes, something that's on the minds of lawmakers, policymakers, and taxpayers around the country. We're going to cover the tax at a high level. We're going to look at relief options and sound tax policy. We're also going to look at what elimination efforts might entail and what that might mean for you and your state. So let's get started. The property tax is often said to be the most hated tax, but in truth, it's both efficient and essential. In fact, it's one of the few revenue generators available to local government, and across the country, over 70% of local government revenue comes from the property tax. Looking at all taxes, it accounts for 30% of state and local tax revenue. So you can see the importance of the tax and how it impacts your daily life. When we think about the property tax, it's important to look at its components. One, it's transparent. What does that mean? It means the property tax is known by anyone who pays it. If you ask a property owner what they pay in property taxes, the chances are they'll tell you down to the cent how much they owe. Ask that same taxpayer how much they owe in sales taxes, and you'll probably be greeted with a shrugged shoulder. Property tax is also neutral when it's structured well. And what does that mean? A well-structured property tax does not preference some property owners over others. Generally, the property tax is said to comport with the benefit principle of public finance. All that means is you pay for what you get. The property tax is also self-reinforcing. And we see that every day. As we pay property taxes, as we fund our local services, fire departments, police departments, roads, schools, and our communities get stronger and more desirable to live in, our property values tend to rise. And that's what we mean when we say the property tax is self-reinforcing. The property tax is also relatively efficient. And what do I mean by that? I mean that it does less harm to the economy than other taxes. And this is really important to consider, especially if you're in a state that is considering eliminating the tax entirely. So when we think about property, we can think about the types of property. First, we have real property. That's land and structures. These are properties that are fixed in place, not movable. Then there's tangible personal property. That's movable property. Think machinery, equipment, but things that's easily moved from one place to another. And of course, we have intangible property. That's intellectual property, financial assets. You might not be able to touch them or necessarily feel them, but you can certainly move them, and they are a type of property. When we think about the property tax, we think about how property is classified or the classes of property. That can be residential, commercial, agricultural, industrial, utility, and other places, many more different classes of property. It's on these classes of property that we apply tax rates. Now, these are often expressed in millages, but for the purpose of this presentation, we're going to talk about them as tax rates. And we look at the tax value of a property compared to, say, the market value. And that's going to incorporate an assessed value. So the property is assessed on an assessment cycle, and we apply an assessment ratio to that assessed value, and we get tax value. And against the tax value, we levy the property tax. So how do we value property for purposes of taxation? Well, we look at things like comparable sales. We can look at the cost method of property valuation, and that's just looking at the replacement cost of that property or what it would cost to build that property now. We look at the income potential or the use of that property. But it's important to understand how your jurisdiction is going to value your property for tax purposes. The assessment ratio, as I mentioned earlier, is used to determine the amount of your property's assessed value that's subject to tax. Now, you may have heard the term property tax capitalization. And all that means is that property taxes do, in fact, have an impact on prices. Generally, we say that properties that are subject to lower tax burdens tend to see higher prices, vice versa. So how often are properties assessed? Well, it depends. The span can vary. Generally, we see assessment cycles of around 2 to 5 years. Some states require annual assessments and others have longer periods. There are certain things that can trigger an assessment in a non-assessment year. That could be a major home renovation. If your jurisdiction views building a bathroom or adding a new addition onto your home as a major renovation that could trigger a new property tax assessment. Obviously, sales trigger a new property tax assessment. And there are some issues to consider when we look at how long the assessment cycle is. Longer assessment cycles actually cause or may cause distortions. That's particularly acute if market values of properties have either increased or decreased. So let's look at the increasing market value. If the market value has increased dramatically over the course of the assessment cycle, in a non-assessment year, that property owner is going to be paying far less than they would had the property been assessed in the current year. Similarly, if the property had fallen in value, the taxpayer would be paying more than they would normally have done had the property been assessed at the current year. So looking at the length of the assessment cycle will help determine whether or not there are distortions in the system or not. Property is generally listed on what's called a tax roll. It's the official list of all the properties that are subject to tax. Now, this list isn't always a single list. It can be what we call a split rolls. This is a non-neutral, unsound property tax policy that is in many states. Split roll is simply this. It's a system where different classes of property, think residential, commercial, agricultural, etc., are taxed at different rates or subject to different assessment ratios. All around the country, lawmakers and taxpayers are seeking ways to implement property tax relief or to limit the burden of property taxes. This is nothing new, and some of these concepts you probably have heard of. Circuit breakers are one. They limit taxes for certain homeowners, low-income homeowners, or even retirees. Homestead exemptions, which we're going to come back to later, limit the amount of a resident's assessed value that can be subject to taxation. So it just limits the amount of a home's value that can be subject to taxation. Property owned by the government and nonprofits is generally exempt from property tax. That includes universities, churches, hospitals, and government property. Abatements are often available for economic development purposes. What is an abatement? It simply is a reduction or an elimination of property taxes for a period of time for certain taxpayers to spur economic development or to remedy housing shortages. And something that you may have heard of called tax increment financing or TIF financing is a tool used by local government to encourage economic development. It simply captures a future property tax increase for new development. There's a lot that can be said on tax increment financing, and we don't have enough time to get into it today. It certainly could be its own session. But just know that tax increment financing often papers over uncompetitive rates, especially when your system features a split roll. Now, going back a little bit, we mentioned tangible personal property. This is property that can be touched, it can be moved, machinery, equipment, and a number of states tax tangible personal property. Now, that creates its own issues in the economy. It can create timing issues for certain things. It can create where we move certain property at certain times of the year. But generally, taxes on TPP or tangible personal property disincentivize investment, and they distort, as I said, economic decision-making. Generally speaking, revenue resulting from tangible personal property taxes is minimal, especially when you compare that to the high cost of compliance borne by the taxpayers. So how are states dealing with this? States are considering expanding what's known as a de minimis exemption, or an amount that is stated in statute that is just simply not subject to taxation, and anything above that limit would there be subject to taxation. That really helps small and mid-sized businesses that don't have the compliance budgets or the personnel to accurately and actively track tangible personal property for tax purposes. Other states are considering phasing the tax out over time. Again, generally the revenue is minimal, and so phasing it out over time often does not cause significant revenue challenges for states. And states are considering allowing local option to exclude the TPP from the property tax base. So allowing localities that otherwise would levy the TPP tax to selectively opt out of levying it. Common relief strategies that you may be aware of. Again, we covered homestead exemptions. Just reviewing, it limits the amount of a residence's assessed value that is subject to taxation. On paper, this may sound great, but in reality, it simply creates a burden shift to other classes of property, often renters and commercial property. If you live in a jurisdiction where an apartment complex is classified as a commercial property, the burden that is shifted from resident homeowners to that apartment complex would not be borne entirely by the property owner. In fact, the increased property tax would most likely be passed along to the renter in the form of higher rents. So we're shouldering renters with homeowner property tax relief. It's not neutral, and it, in the long run, is simply a burden shift. You may have heard of assessment limits. They limit the amount that assessed values can rise over time. What this does is it creates a lock-in effect. Essentially, if the homeowner is enjoying a lower assessed value or a cap on their assessed values, they're less likely to trade up to a larger home when their family size or income permits or requires. That really reduces supply for first-time home buyers and lower income home buyers. It also discourages new construction that would be subject to a new assessment limit or a new assessment. And it discourages major home renovation. Because remember, a major home renovation can trigger a new assessment even in a non-assessment year. It's very possible under an assessment limit for two properties that are neighboring on the same street to pay radically different property taxes based only on date of purchase. That is the consequence of an assessment limit. A rate limit is exactly what it sounds like. It limits the amount that property taxes can rise, the rate can rise. Sounds great, but in fact, it does nothing to counter rising property valuations, which is something that we've seen in recent years. Another option for property tax relief is what we call a tax swap. There's a number of types of swaps, but generally it's what it sounds like. It swaps one tax for another. It either a state level tax for the local property tax or another local tax for the local property tax. These can be really complicated if not tracked and structured correctly, could be really ineffective. There's also some fairness issues, generally concerns about safeguarding against future tax hikes, and often local governments are not prohibited from raising those rates in the future. And what really can happen through these tax swaps is they become a subsidy for local government and not a true relief option. We have a case study here. We can look at New Jersey. New Jersey instituted an income tax to provide property tax relief. This was done in the 1970s. Now, New Jersey has among the highest income tax burdens and property tax burdens in the country. It didn't work there, and I would be cautious about pursuing it anywhere. Levy limits are the most neutral property tax relief option. Levy limits constrain collection. They constrain the collection of the property tax to ensure that government is adequately funded, but that government is not receiving a windfall when property values surge, as they have in recent years. You, of course, can adjust for population growth and inflation. Now, how does this work? As valuations rise, everybody pays less. That does mean there may be fluctuations over time, but collections generally remain stable. So the government is able to predict and understand how much they will need and how much they will receive in order to pay for essential local services. Now, of course, voters should be able to lift these limits at the polls and exercise their right to do so. But consideration should be given to threshold for qualifying to make the ballot and timing of these elections. You may consider pairing a levy limit with the truth in taxation law. That's a mechanism to provide homeowners with more information about their property tax bill. Taxpayers generally should be able to see what the bill could have been if a levy limit were in place or if the levy was frankly strengthened. These are combined often with the ability of the public to comment on any proposed tax changes. Utah was the first to adopt the truth in taxation law and later added levy limits. It's important to note that Utah has a strong culture of participation, but these work. Levy limits and truth in taxation laws work to help provide meaningful relief to taxpayers that does not do undue harm to the economy. And just going back to what I mentioned earlier, providing unsound property tax relief can really shift the burden onto those who may least be able to afford it. And I think this should be considered anytime we're looking at shifting or providing certain relief to homeowners at the exclusion of other classes of property. In recent years, we have seen property valuations around the country surge 40, 50, 60%, in some places much more. And property owners are rightfully clamoring for relief, and lawmakers are trying to find ways to provide it. We talked about property tax relief options, but in many instances, we're looking at states now that are considering eliminating the tax entirely. We are very much in a property tax revolt. It's not the first time in American history that this has happened, but it's important to recognize that it's happening now. So what are some common arguments against the property tax? One very common argument against it is that it feels like you're renting your property from the government. Now, going back, the property tax has a benefit to it. We pay our property taxes and we receive the benefit of local services. Buyer, protection, police protection, schools, better roads. These are then helping to raise our property values over time. And that leads to the second criticism of property tax. Property tax is a tax on unrealized gain. A third very common argument against the property tax is that property valuations are unfair or incorrect. And as we said before, property taxes are very transparent. Property owners know what they're paying in property taxes. And in many jurisdictions actually have the ability to contest the tax bill. They can contest the valuation that has formed the bill that they received in the mail. They can challenge an unfair or perceived unfair valuation. But these are very common arguments against the property tax. So why is it that the property tax is so hated? Well, one, we've said it a couple times today. Taxpayers are aware of how much they're paying. It's often one that you can contest. But also, property tax terminology is really confusing. We use things like millages that we don't use in other tax areas. We look at assessment ratios. And so while we know how much we're paying, we often don't understand how that number was arrived at. And that certainly contributes to some of the disdain and the dislike of the property tax. As I'm talking to you today, a number of states around the country are actively considering eliminating the property tax. You can see the list here. Others are considering it as well. These are the states that are actively considering it at the moment. And I want you to think about what might happen to these states, especially those states that don't have an income tax. Think Texas, Florida, how they adequately fund local services. It's a consideration that's on the minds of lawmakers and taxpayers everywhere, especially when we go back and think that property taxes make up over 70% of local revenue nationwide. It's a lot of money to replace. Nebraska voters were presented with an option. It didn't end up making the ballot, but the signatures were collected. And the option was to eliminate all property and income taxes, including local inheritance tax, and replace all revenue with a statewide consumption tax. Now, localities were also able to institute a local option consumption tax, but for the purposes of our discussion, we'll look at the statewide rate. Proponents of the EPIC plan suggested that a statewide consumption rate of 7.5% would be sufficient to replace revenue. Here at the Tax Foundation, we looked at those numbers ourselves, and we calculated a rate of nearly 22% would be required to replace revenue as it existed at the time. 22% or 21.6% was a specific number we determined is a lot. It would be a national outlier. What's more, if you were a Nebraskan that happened to live near a border where you could go across the border to do your shopping, that would likely happen a lot, leaving the extraordinarily high consumption tax rate to be paid by those who lived the furthest from the border or who were in the interior of the state. This, had it passed, which it didn't make the ballot as I mentioned, but had it passed, it would have really eroded the gains that Nebraska had been making. It certainly would have reduced the state's regional and national competitiveness. Now, Florida, we mentioned that Florida is considering eliminating the property tax. Now, as I mentioned, Florida does not levy an individual income tax. So we looked at what it might take to replace the local property tax revenue by increasing the statewide and local sales taxes. So what we estimate is this: combined state and local average sales tax rate would have to increase from the current rate of 7.02. Again, that's the combined state rate and the average local rate, 7.02%. That would have to rise to 15.34%. Now, that's not everywhere. Jefferson County, which is the county in green to the right of Tallahassee, it's on a major thoroughfare with sufficient retail and traffic. Jefferson County could get by with a combined rate of 9.8%. But if you look at Glades County, which is the county in dark blue to the right of Fort Myers, it's a rural county without the same infrastructure that we see in Jefferson County or the same traffic. And there, the rate would likely need to be over 32%. Those are seriously high numbers. And Glade County would be an outlier, as would Jefferson County, but even Florida would have a very high average state and local rate. Ohio is another state considering property tax elimination. So there we looked at what might happen if income taxes were authorized at the county level to offset lost property tax revenue. And additional rates in the state would average 8.35%. That would bring the statewide average, which includes existing state and municipal income taxes, to over 12%, 12.59%. Now, to put that in context, that would be on par with California's top marginal rate on income over $1 million, just to put that into context. So we can see how Florida would struggle with very high sales tax rate, how Ohioans might suffer from a much more steep burden of individual income taxes. So what happens if the state comes in and takes responsibility for replacing the revenue? So here we looked at Nebraska again. And what we looked at was what happens if the state were to subsidize local government and local government lost property tax revenue? Because that's what it would be, a subsidy. And what ends up happening is a transfer. Because if the state were to come in and subsidize local governments for lost property tax revenue, it would reward those jurisdictions that levy high property taxes, taking that revenue entirely. It would be on the backs of those jurisdictions that don't levy high property taxes. And in that sense, it would very much be a rural to urban transfer. And just as important, residents in the state would lose the ability to control the size and the scope of their local government. It would be taken out of their hands. Our website, taxfoundation.org, has a lot of resources related to the property tax, along with a lot of other information that's valuable. I encourage you to go there. These are two of our latest publications regarding the property tax, specifically property tax repeal, and I encourage you to read those as well. The property tax is an efficient tax. The property tax is an essential tax, but the tax needs to be reformed. There are ways to do it that comport with sound tax policy. I would encourage you to consider levy limits and truth in taxation laws. Thank you for joining me today, and we look forward to the next installment of the State Tax Policy Bootcamp.